Market analysis, module 5. Market analysis. Market analysis involves evaluating market conditions to make informed trading decisions, right? Market analysis just means you are evaluating these conditions. Say these conditions mostly predict that the market is going to, or price is going to move this way or this way. So that's analyzing. You are just basically gathering data so that you can predict or anticipate the next movement. Types of market analysis. There are 3 types of market analysis. The first one is called fundamental analysis. This is analyzing based on economic data like interest rate, inflation, GDP, and employment. Right? You can understand this is basically the economic of the country you are, of the current country you are trading the pay. Right? If you are trading the dollar, you want to know the economy of the United States. If you are trading Swiss francs, you are trying to understand the economy of France, right? So then we have the second one called technical analysis. This is based on price charts, patterns, and indicators, right? This is basically now you are dealing with how pricing history, right? You are dealing with pricing history. What was history repeats itself, right? So what happened some time ago will happen again, right? Price tends to do that, right? Then the third one is sentiment analysis, right? Gauging the overall mood of traders, right? Fear or greed, right? How overall the traders are reacting to the markets? How are they trading? How are they feeling? They are feeling right now. Are they anxious? Are they greedy? Are they afraid to execute all that stuff? Can help you make an informed decision or make a prediction about where the market price might go. Because I forgot to tell you this earlier. Because remember, price follows the money, right? The market follows the money. So where there is a lot of money, the market goes that way. So if the buyers have a lot of money or a lot of volume, the market is going to be going long. And if the sellers have a lot of volume, the market is going to go short. We are going to have a bearish market if the selling volume is a lot than the buying volume. So it's just the battle between the buyers and the sellers. So what wins is the larger volume, right? Describe the market analysis, right? So let me describe market analysis. Fundamental analysis helps you forecast long-term trends by evaluating the strength of economies, right? You can't honestly tell me 1 day, 2 days can tell you how the economy is strong, but quarterly or half a year or yearly, you can now anticipate the economy of the country is depreciating or it's evolving or it's recovering or whatever it might be. There might be war, there might be destruction of buildings or property, where all that stuff will affect what the economies of the country, right? Then technical analysis uses historical price movements to predict future price behavior. Traders use tools like candlestick chart, support, resistance, levels, and indicators. This is where we are going to mainly focus on the technical analysis, right? This is where I'm going to teach you, and so that you can master the technical analysis. I'm also going to teach you fundamental analysis and sentimental analysis, but I'm going to first mainly focus on the technical analysis. Then sentiment analysis can help you understand if traders are overall bullish or bearish, right? Just like I was saying, right, in the previous slide, it helps you understand the overall behavior of the traders, right, which can indicate possible result. Right, I'm going to teach you and help you analyze the market in a better view and see how this game is played. So we have so for this analysis to work, you need to understand that in trading there are trading sessions, right? What are trading sessions? These are just the times where major banks open and close, right? So we have 3 main sessions which happen in Asia, Europe, and America, right? So the first session is called the Asian session, and these times are GMT +2, which start at 2:30 hours, right? 2:30 hours, and they end at 900 hours, right? And we move on to London. Then London starts at 9:30 and ends at 1500 hours, right? Then we have the US session or the New York session. We start at 15:30 and ends at 23:00. And we have what is called a dead gap from 23:00 to 200 hours, right? 30, and you can see there are 30 minutes gaps between, you can see between 9 o'clock to 9:30 before the London Open, there's a 30 minutes gap, and between 15:00 to 15:30 there's a 30 minutes gap, and also between 2:00 to 2:30 there's a 30 minutes gap also. It's called a gap time. This is a change of a gap time where the bankers from this session are now passing on information to the bankers of other session, right? So that's basically it.